Good morning, Tony Sycamore here, bringing to you a video review of the 5 key charts that matter for the week ahead starting the 8th of March. Let's start with the US 10-year Treasury yields. Again, this is without doubt the market which is creating all the volatility in all the other asset classes and really the number one chart that we need to be across for this week. What you can see here is the decline which occurred from October 2018 down to the COVID lows around 0.36% from 3.25%. The appreciation that we have seen since the COVID low has been very gradual up until this point here. And this is what is really starting to create the volatility in other asset classes. However, as can be noted here, the US yields are now testing this trend channel resistance. And we're starting to see a little bit of selling come in. We popped up to around 1.62% last week, which will fix that up right now. But what you're seeing is there is a bit of a resistance area right here. So it wouldn't be unreasonable to start to expect to see some consolidation around this 1.5% level at the very least. What we do need to be aware of, particularly for people that are trading equities, high growth, high tech stocks such as Tesla and that type of thing, this is now resistance here. And if the US 10-year yields can push above this area, then there's a risk they push up to the next resistance area, which comes in around 1.75 to 2%. And that, I think, would be a bit of a problem for markets, particularly if it happened quickly, not so much if it was a gradual move. Looking at the bellwether US stock market, the S&P 500, it has continued that upward choppy price action that we've seen since November. It's really a case of 2 steps forward, 1 step back. You can see on the daily and the weekly chart that some trend channel support was tested and it did hold. We highlighted this in last week's video. We said around that 37.40 to 37.30 area. It did go a little bit below there, but you can see it was a conclusive bounce on Friday and it has closed back around the middle of this trend channel. I see now this being more of a corrective, one of the 1 step forward, one of the 1 step back. And we're going to see 2 steps forward now, providing those US equities, providing those US 10-year yields really consolidate around that 1.5% area. And that should see the S&P push up towards 4,000. I don't want to see a break below these lows here. If the S&P was to break below these lows, then we need to look for a deeper decline towards 35.30, which is this trend channel support here, potentially towards the 200-day moving average, coming around 34.65. The local market, the ASX 200, not a lot has changed here in the grand scheme of things, but what I do like is that we're trading in an upward sloping trend channel, much like the S&P 500, which probably isn't a surprise. But the key takeaway here is that the ASX 200 really hasn't seen the sell-off that the high-tech US indices have seen. And that's because we are full of cyclical stocks here, which are supported by rising yields as a whole, things like resources and banks. And for that reason, the ASX 200 is comfortably holding this area here on Friday and would be expected to open up around 6,800 on Monday. Potentially, we can look for a test of 7,000 in the coming weeks. Looking now at currencies. Now, there's really a representative chart for me being dollar yen that picks up all of what is going on in the US dollar complex at the moment. This is a monthly chart of dollar yen. And what you can see here is some very good trendline resistance coming from June 2015, this 125.84 high. It picked up a number of other highs and it's coming in right now around 109. Why it's representative of US dollar pairs as a whole is I think we have pushed, the US dollar's pushed into resistance or in so many of these currency pairs. When we're looking at the euro back towards 118.50 should be good support. The Aussie around 76 cents, 75 cents is very good support. The Kiwi at 71 cents. All of these markets are now testing really the resilience of US dollar strength. And if yields consolidate, like I do think they will in the coming weeks, I would be prepared for a little bit of US dollar weakness in coming weeks, which should take dollar yen back potentially towards, I don't know, 105, that type of thing. And you'd see the Aussie retest highs, potentially the Kiwi retest highs. This is the daily chart of dollar yen. You can see this is quite an impulsive move that we've seen in line with that rally in US yields. If US yields start to pause like I think it will, dollar yen should start to find but going a little bit tougher here on the top side, and potentially you could start to look to be a seller in this area here, looking for a retracement back towards 106, 105 area, as we mentioned. Finally, this week, a look at Bitcoin. Now, I am still looking at this 58,000 high as a potential wave 5 high. It's not confirmed. What would confirm a deeper corrective pullback would be firstly a break of this trendline resistance, which we have redrawn a little bit lower. But more importantly, I see this high from January as being the crucial level. 42,000, it picked up this low here at 43,000. A break below 42K would see for mine a pullback towards wave equality coming in around 37,000, potentially back towards the 200-day moving average support coming in around 34,000. Now, if Bitcoin gets into this area here and we start to see some stabilization, I think that would give us the setup to start to look to re-enter longs in Bitcoin. Keeping in mind, if Bitcoin doesn't fail below or doesn't fall below this trendline support, we do need to allow for another push higher up towards this area here without first getting that pullback that we'd really like to see. Folks, that is all for this week. Thank you very much for listening. If you are interested in more of the trade ideas and chart analysis which we provide in this report, our members do get all this and a lot more. You can find out the details on our website. There is a 1-month trial for $4.99. Feel free to check it out. Thank you for listening.